A retired pharmaceutical sales director in Connecticut walked into his accountant's office in February of 2026, holding a Medicare bill that had just gone up by $4,752 for the year. His name was Richard. He was 66 years old. He had retired 4 years earlier at 62, with $2.1 million in his individual retirement account, a paid-off house in Fairfield County, and what he thought was a sensible plan. In 2024, the year he turned 64, his financial advisor had recommended converting $200,000 of his traditional individual retirement account into a Roth. The logic was sound. Required minimum distributions were coming. Tax rates were scheduled to rise. Better to pay the tax now while he was in a lower bracket. So Richard wrote the check. $44,000 in federal tax, $8,000 more to Connecticut. He thought he was being smart. What nobody told him was that the conversion he did at 64 would follow him into Medicare for the rest of his life, adding nearly $5,000 a year to his Part B and Part D premiums starting at age 66. And the mistake he made on the advice of a licensed professional is the same mistake hundreds of thousands of retirees are making right now in the most expensive window of their lives. Here is what happened. And here is exactly how the timing of one decision determines whether a Roth conversion saves you money or quietly drains it for the next 20 years. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me anchor this with the one rule that almost nobody understands until it is too late. The Medicare income-related monthly adjustment amount, which everyone in retirement planning calls IRMAA or IRMAA, is a surcharge on top of your Medicare Part B and Part D premiums. It kicks in when your modified adjusted gross income crosses certain thresholds. In 2026, a single retiree with a modified adjusted gross income above $106,000 pays an extra IRMAA surcharge. A married couple filing jointly pays the surcharge above $212,000. The surcharges climb in tiers. At the top tier, a single retiree pays an additional $443.90 per month for Part B alone, plus another $85.80 for Part D. That is over $6,300 per person per year in extra Medicare costs. And for a couple, it is over $12,700. Here's the part that traps people. IRMAA does not look at this year's income. It looks at your tax return from 2 years ago. So your Medicare premium in 2026 is determined by what you reported on your 2024 tax return. That 2-year look back is the entire reason this video exists. Because if you do a Roth conversion in any year that lands inside that look back window, the surcharge follows you into Medicare and stays attached to that year's elevated income forever in the Social Security records. Now here's where it gets critical. There is a window. A specific window of years between the day you stop working and the year you turn 63 when Roth conversions are essentially invisible to IRMAA, because the income from those conversions falls outside the 2-year look-back that determines your Medicare premiums starting at age 65. If you retire at 60, you have 4 full years where you can convert traditional individual retirement account dollars to Roth dollars, and the only cost is the federal and state income tax on the conversion. After your 63rd birthday, every dollar you convert can be counted by Medicare 2 years later, and once it counts, it can push you up an IRMAA tier that costs you thousands of dollars a year for the rest of your life. This is what financial planners call the bridge years, and almost nobody uses them correctly. Let me show you what this looks like in real numbers across 3 different households. Scenario 1. Diane, a 60-year-old former school district superintendent in Pennsylvania who retired at the end of 2025. She has $900,000 in her traditional individual retirement account. She has a small pension of $28,000 a year. She is delaying Social Security until age 70. Her husband is also retired with a similar pension. Their combined taxable income before any conversion sits around $55,000. Diane sits down with a planner who actually understands the bridge years, and they map out a 4-year conversion plan running from 2026 through 2029, the year she turns 63. They convert $50,000 per year for 4 years. Total converted, $200,000. Their effective federal tax rate on those conversions stays in the 12 and 22% brackets. And their state of Pennsylvania does not tax retirement income at all on those individual retirement account distributions. Total tax cost over 4 years, approximately $30,000, which works out to about 15% effective. Now the magic. Because every one of those conversions happened before Diane turned 63, none of them appear in the IRMAA lookback for her first year of Medicare at 65. She walks into Medicare paying the standard Part B premium with 0 surcharge. Same for Part D. Her $200,000 Roth balance now grows tax-free for the rest of her life and never triggers a required minimum distribution. Same input, different output, depending entirely on when the conversion happened. Scenario 2. Richard, the 66-year-old pharmaceutical sales director in Connecticut from the cold open. Same situation in many ways. He retired at 62 with $2.1 million in his individual retirement account. But Richard did not start his conversions early. He spent his first 2 years of retirement traveling, paying off the last of a remodel, and not thinking about taxes. In 2024, the year he turned 64, his advisor ran the numbers and said the traditional thing. Convert now while you are in a lower bracket. So Richard converted $200,000 in a single year. His federal tax bill on that conversion was about $44,000. His Connecticut tax was another $8,000. He paid the bill and moved on. Then in 2026, he turned 65 and signed up for Medicare. He filled out the forms, he picked his Part D plan, and the first bill arrived showing a Part B premium of $633 per month instead of the standard $185, plus an additional Part D surcharge of $74 per month. That is over $4,752 per year in extra Medicare premiums, all because his 2024 modified adjusted gross income, the year of the conversion, came in just above the second-tier IRMAA threshold. And here's the brutal part. That surcharge does not last 1 year. Because his single conversion pushed him into a higher tier, and because his ordinary retirement income is going to keep him at or near that threshold going forward, Richard is looking at IRMAA surcharges potentially for years. Over a 15-year horizon, that one mistimed conversion could cost him $40,000 to $70,000 in extra Medicare premiums alone. The conversion did exactly what the advisor predicted it would do on paper. It just did it in the wrong year. Scenario 3. Sarah, a 61-year-old former nurse practitioner in North Carolina who retired at the end of 2025 with $800,000 in a traditional individual retirement account and a husband still working full-time as a contractor earning around $160,000 per year. Sarah looked at the bridge year strategy and thought she had 2 clear years to convert before she turned 63. She converted $75,000 in 2026. She paid the tax and felt good about it. Then, in 2027, she went to pull $30,000 out of the converted Roth to help one of her adult children with a down payment, and her tax preparer caught something that almost nobody talks about: the 5-year rule on Roth conversions. Each separate Roth conversion has its own 5-year clock that runs from January 1st of the year of the conversion. If you withdraw any of the converted principal before 5 years have passed and before you reach age 59 and a half, you pay a 10% penalty on the converted amount. Sarah was over 59 and a half, so the 10% penalty did not apply to her. But for someone who retires at 55 and converts aggressively, withdrawing those converted dollars in the first 5 years is a real trap. Sarah dodged the bullet because of her age. The lesson is that conversions are a long game, and you do not move money into a Roth that you might need to spend in the next 5 years. Now here is the part that changes everything. The reason this window exists, and the reason almost nobody tells you about it, comes down to a quiet structural feature of how Medicare and the Social Security Administration share data. IRMAA is calculated automatically every fall by Social Security pulling your modified adjusted gross income from the Internal Revenue Service. The lookback is 2 years. Always 2 years. So your 2026 Medicare premium uses your 2024 return. Your 2027 premium uses your 2025 return, and so on. This means the last year that can possibly affect your first year of Medicare at age 65 is the year you turn 63. Anything you do before age 63 is invisible to the first year of Medicare. Now extend that logic. The conversion you do at age 63 affects your Medicare bill at 65. The conversion at age 64 affects you at 66. The conversion at 65 affects you at 67. Every late window conversion casts a 2-year shadow into your Medicare future. And because IRMAA tiers are based on hard cliffs, not gradual phase-outs, going $1 over a threshold can cost you over $1,000 in additional premiums for the year. There is no proration. You either are in the tier or you are not. Most financial advisors I worked with for 2 decades did not run IRMAA projections. They ran tax bracket projections. They told their clients to convert into the 22% bracket without ever mentioning that crossing one of those brackets after age 63 could trigger a surcharge that effectively turns a 22% conversion into a 30% conversion once you count the Medicare cost. Here is your action checklist. 1. Find out the exact year you turned 63. That is the last full year of conversion freedom. Mark it on the calendar. 2. Pull your most recent traditional individual retirement account statement and any other pre-tax accounts, including old 401k balances, and figure out your total pre-tax retirement balance. 3. Project your required minimum distributions starting at age 73 under the Secure 2.0 Act. The Internal Revenue Service publishes the Uniform Lifetime Table inside Publication 590. Run the math. If your RMDs are going to push you into a higher tax bracket or a higher IRMAA tier in your 70s, you have a conversion problem to solve. 4. Look up the 2026 IRMAA brackets at Medicare.gov. Single filers above 106,000, joint filers above 212,000. Memorize the cliffs above your current income. 5. Calculate how many full tax years exist between today and the end of the year you turn 62. Each one of those years is a free conversion year for IRMAA purposes. 6. Set a target conversion amount for each bridge year that fills up your current tax bracket without pushing you into the next one. The standard deduction in 2026 for a couple over 65 is approximately $32,000 and $2,025 in standard, plus a senior bonus deduction. Use that headroom. 7. Do not convert money you might need to withdraw within 5 years. The Roth conversion 5-year rule, governed by Internal Revenue Code Section 408A, is real. 8. File Form 8606 with your tax return for any year you do a conversion. Without it, the Internal Revenue Service has no record that you already paid tax on those Roth dollars, and your heirs could end up paying tax on the same money twice. 9. If you are already past 63 and you absolutely must do a conversion that lands in the IRMAA lookback, file Form SSA 44 with the Social Security Administration if you have a qualifying life event such as work stoppage, marriage, or divorce. It is the only way to appeal an IRMAA surcharge. 10. Talk to a fee-only certified financial planner who specifically runs IRMAA projections, not just tax bracket projections. If your advisor has never said the word IRMAA out loud to you, find a different advisor. Let me put a dollar amount on this so you understand the stakes. 2 retirees, same starting balance, same total amount converted, same federal tax bill. One does the conversion at 61, the other does it at 64. The first one pays roughly $30,000 in tax and walks into Medicare paying the standard premium for life. The second one pays the same $30,000 in tax and then pays an additional $4,752 per year in IRMAA surcharges starting at age 66. Over a 20-year retirement, that is nearly $95,000 in extra premiums. Same conversion, same dollar amount. One decision cost $95,000 more than the other, and the only difference was the calendar year on the tax form. That is not a loophole. That is the 2-year IRMAA lookback written into Section 1839 of the Social Security Act. It has been the law since 2003. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know someone who retired in their early 60s and is sitting on a large, traditional individual retirement account they have not started converting yet, send them this video today. Their bridge years are closing fast, and nobody else is going to flag it for them. And in the comments, tell me this. What year do you turn 63, and how much have you already converted toward Roth? I read every single one, and the most common questions become future videos. I will see you in the next.